Bitcoin is sitting around 64,700 right now, and the loudest bear call on the desk today says it rallies to 67,000, maybe 70,000, and then loses up to 90% of its value. $12,000 Bitcoin. That is the call. From the BTG Desk, we are going to put that exact roadmap on our own charts, level by level, and then check it against something the pattern callers do not have. The live order book, the liquidation map, and the news tape, all pulled from our own desk tonight. Stay for the full map, because the last level is the one nobody is pricing. Here is the structure everything else hangs on. Bitcoin topped at 126,000 late last year, crashed more than 50%, and printed a low at 57,718 in early July. Since then, prices climbed back into the mid-64,000s, a bounce of roughly 13% off the floor, with an intraday high a few days ago at 65,550. The bear read treats that entire bounce as a wave 2, a counter-trend rally inside a larger downtrend. In that framework, Wave 1 down is complete at 57,718, Wave 2 is playing out right now, and Wave 3, historically the longest and most violent leg, is still ahead. They even frame the bounce as an ABC, an A leg up, a B dip, and a final C wave that carries price into the 67s before the floor gives way. Look at our daily chart and you can see why the story sells. Price has just reclaimed the 20 and 50-day averages tonight, but the 100-day waits overhead at 70,370, the declining 200-day at 73,160, and the May lower high is intact. A 13% bounce has not broken one piece of the larger downtrend structure. That part of the case is simply true on the chart, and pretending otherwise is how people got wrecked buying every dip from 126 down. One wrinkle worth knowing. Plenty of traders now call this an inverse head and shoulders, a classic bottoming pattern with the head at 57,718. The bear counter is blunt. The same pattern got called at 80,000 and again at 60,000, and both times it was the halfway house of a bigger decline. Patterns are cheap. Levels settle arguments. So let's do levels. Where does this bounce run out of road?
3 numbers stack up in a tight band from 3 different tools agreeing with each other, which is exactly what makes a level worth respecting. First, 67,000. Measured off the leg down from the May high near 82,800 to the July low, the 38.2% retracement lands at 67,304, almost exactly on the June swing high. Old resistance plus a retracement shelf in the same spot. Second, 70,000. The 50% retracement of that same leg prints 70,266, sitting right on top of the 100-day moving average at 70,370. 2 more tools, same neighborhood. Third, 71,000 as the hard cap, with the 200-day average and heavier weekly resistance clustered at 73 to 74,000 above it. The bear roadmap is explicit. The rally terminates under 71. Most likely, it dies just under 67,000 or with a brief overthrow above it to trap breakout buyers. A close above 71 starts breaking the count. A push through 74 shreds it completely. Write 3 numbers down: 67, 70, 71. That is the scoreboard for the whole call. And keep the calendar in view. The next Fed meeting is about a week and a half out, and this roadmap wants the classic sequence: drift up into the meeting on rate cut hope, sell the event. Now, the scary half. The claim is that 57,718 is not the bottom, not even close. 3 shelves below, each with a different quality of evidence. Grade them separately. Shelf 1, 37,000. The lower channel line on the long-term chart, roughly a 70% drawdown from the top. The strongest single fact in the bear arsenal lives here. Bitcoin has historically never printed a bear market bottom without tagging its lower long-term envelope, and that envelope currently sits in the mid-30,000s and falling. 2015, 2018, 2022, every prior bear ended with that tag. Shelf 2, 25,000. The measured move off the topping structure, an 80% drawdown, which is what both the 2018 and 2022 bears delivered almost to the digit. This shelf is basically this bear equals the average bear. Shelf 3, the nuclear one, 12,000 to 13,000, 90% down, matching Bitcoin's earliest
ugliest bears.
On our monthly chart, the long-term channel support does run through the 12 to 15,000 zone. The line exists, but reaching it requires a 14-year-old ETF-held asset to repeat its infancy. That is the thinnest part of the argument, and not coincidentally, the number doing all the marketing. And here is the tension inside the bear case itself: diminishing cycles. Each Bitcoin bear has been shallower than the last, and even committed bears concede it. Their fallback is telling. Even if this cycle only drops 70%, that is still 37,000. Notice what happened. The 90% headline quietly became a 70% fallback. The gap between those numbers is $25,000. When a forecast carries an error bar that wide, you trade the levels, not the forecast. Every crash call needs a trigger, and this one is macro, a chain with 4 links. Link 1, escalation between the US and Iran deepens. Calm read, that is a scenario, not a schedule. Nobody trading this chart knows the timeline, including the people confidently predicting it. Link 2, oil. Crude is already up over 20% from its early July bottom. If escalation accelerates, energy rips, and the cooler CPI prints Bitcoin has been rallying on reverse into an inflation scare. Link 3, the Fed. The entire bounce has been fueled by cooler inflation prints and cut hopes, and those hopes only survive if energy stays quiet. An oil shock kills them completely. Link 4, risk assets reprice. Stocks finally play catch down to Bitcoin, which topped months before the indexes, and Bitcoin gets its wave 3. Some texture is already on the tape. The VIX broke out of a falling wedge on Friday and reclaimed its 50-day average. You can see the breakout on our VIX chart. The S&P and NASDAQ printed their first meaningful gap down, and the same wave 2 label on Bitcoin is being applied to the indexes. Then the twist ending, the most interesting claim in the thesis. After the crash, the Fed panics into jumbo cuts, even while inflation is still rising. Sounds impossible until you check history. In 2000, the Fed hiked, markets tanked, and by January 2001, they reversed into emergency cuts. In 2007 and 2008, inflation was rising faster than today. An oil shock, same as this scenario, and they cut aggressively anyway. Both times, the Fed chose the economy over the inflation fight. The roadmap says this rhymes: crash first, panic pivot second, possibly around the midterm elections, and that pivot prints the real bottom. Seasonal note, Bitcoin fell into the midterms in 2018 and in 2022. 3 data points are not a law, but they are a pattern. So the full sequence being sold: rally to 67, crash through 57, capitulate somewhere between 37 and 12, Fed panics, moonshot. Ambitious. Now let's do what the pattern callers cannot. Check it against live positioning. This is the part you only get here. On your screen is our live depth map, snapshotted tonight with Bitcoin at 64,777. 2 things jump straight off it. First, the resting book below price is heavier than the book above it, about 13,000 coins bid against roughly 10,500 offered. Buyers are staged underneath. Second, the tape disagrees. Sellers have controlled the last hour of aggressive flow 2-1. Passive bids under the market, active sellers hitting into it, that is a market bracing, not trending. Our desk model even flagged a scalp long off it tonight. Entry 64,706, target 64,823, $100 range trade. When the best setup on the board is $100 wide, nobody with size is committing yet. Now, the deep view, this still. Watch where the whale money sits. Short cluster stacked overhead, roughly 291 million, 117 million, and 58 million in shorts layered above current price, with the biggest single ask wall, nearly 3,000 coins, parked at 66,073. Long clusters sit below at about 87 and 174 million. Read that against the bear roadmap. The whales are positioned for exactly the same rejection zone. If price pushes into 66 and 67,000, it is pushing directly into their wall. And if it punches through instead, those same shorts become fuel for a squeeze. The 67K argument is not just lines on a chart, it is where the money is actually standing. Third still, the liquidation magnet map. The single strongest magnet on the whole board is at 62,163. Heat 89 out of 100, and it is below price. There is a lesser magnet at 65,131 above. Price gets drawn toward heavy fuel, and tonight the heavy fuel is underneath. That is the quiet warning inside all the rally talk. The path of least resistance for a violent move is down toward 62, not up toward 67. And the confluence read from our quant screen ties it together. Bias neutral. Session point of control at 64,451. Price is holding just above value. The anchored volume-weighted average sits near 65,098, which is also almost to the dollar, where the first tranche of 100x shorts starts liquidating. Funding is dead flat. Open interest is climbing off the lows. New money is entering, but nobody is paying a premium for direction. Translation, the market is coiled, positioned, and waiting for the macro to pick the direction. Exactly the shape you would expect if the 67K then down script were live, and exactly the shape you would expect before short squeeze 2. The book tells you where the fight is. It does not tell you who wins. One more desk still, the news tone screen. Across 38 unique headlines, Bitcoin coverage scores plus 0.09 on a scale from -1 to +1. Dead neutral. 15 positive stories, 15 mixed, 8 negative, and the trend is steady. The spread tells the story better than the average. On the bullish side, Bloomberg Intelligence, via Mumu, argues Bitcoin ETFs are likely to mirror gold's 22-year ETF adoption curve. And Bitcoin Magazine reports sentiment turning bullish while warning it is too early to celebrate. On the bearish side, Investing.com ties the rebound towards 64,000 to AI shock and crypto bill doubts, and Yahoo Finance pinned this week's drop to 63K lows on the Trump speech and the new US strikes on Iran. So the tape is split down the middle. No euphoria to fade, no capitulation to buy. A market this evenly divided in its narrative usually resolves in the direction of whichever headline lands next.
Which loops us straight back to the macro chain from earlier. Oil and the Fed hold the pen. Here is how it all scores from the BTG desk. We buy the resistance band, retracement, 100-day average, prior structure, and now live whale shorts and a 3,000 coin wall, all stacked between 66 and 71,000. Fresh money chasing green candles into that band is taking the hardest trade on the board. We buy the regime read. On our 50-50 framework, weekly momentum below its midline while price holds under the 50-week average, Bitcoin has been in a confirmed sell regime since November, and momentum prints near 40 today. 11 separate midline reclaims marked the genuine all clears across the last cycle. It has not happened yet. Until it does, bounces are guilty until proven innocent. We do not buy 90% as a base case. Diminishing cycles, ETF pipes, corporate balance sheets, 2026 market structure is not 2014. 12,000 is the bear's lottery ticket if the world truly breaks. The mid-30s channel tag is the historically grounded version, and even that needs the macro chain to fire link by link. So watch the sequence, not the prophecy. Below 57,718, Wave 3 gets confirmation and the shelves come into play one at a time. Above 71,000 on strong closes, the trap thesis is broken and the map flips. Between those fences, with the strongest liquidation magnet at 62 below and the whale wall at 66 above, expect chop that hurts both sides. The market will announce the winner at exactly those two numbers. No guru required. That is the map from the BTG desk. 67 to 70 overhead with 71 as the kill switch, 57,718 underfoot, whale shorts parked at the wall, the heaviest magnet pulling from 62, and 3 bear shelves far below at 37, 25, and 12 if the macro chain fires. Levels to watch, not calls to trade. Nothing in this video is financial advice. Do your own research, size your risk like an adult, and keep your invalidation closer than your conviction. From the BTG desk, trade safe, and we will see you at the next level.